Thank you, Mr. Chairman. Madam Secretary, first of all, thanks for coming in and sharing with us in front of this committee today. The Federal Reserve wrote in its most recent supervision and regulation report released Friday that, and I quote, "The banking system remains strong overall with robust capital and liquidity and improved asset quality," unquote. Would you agree with their statement?
Yes, to the best of my knowledge, certainly.
Thank you. With regard to what we're doing right now in Russia, I just want to discuss it with you for a little bit. Up until now, bondholders have only been allowed to receive sovereign bond payments from Russia because of a special rule put in place by your department in late February. The General License 9A exemption authorizes U.S. persons to receive interest, dividend, or maturity payments on debt or equity of the Russian government. Despite the extremely strong sanctions placed on their financial system, this has allowed money to flow out of Russia, depleting their stockpile of U.S. dollars. That exemption is poised to expire on May 25th. Their next payments are due on May 27th for bonds maturing in 2026 and 2036, 2 days after the OFAC exemption is set to expire. Will Treasury allow this exemption to expire and allow Russia to default, or would you make other accommodations?
So this is something we're actively examining right now. We want to make sure that we understand what the potential consequences and spillovers would be of allowing the license to expire, and we've not yet made a decision.
When would you expect that decision to be made? I mean, you're talking right now, we're talking just a little over 2 weeks.
It's shortly. We're actively involved in an evaluation of the risks and impact of not renewing the license.
There would be some sort of a report from your department prior to this point. It simply wouldn't be ignored at this stage of the game.
I'm sorry, ignored?
Yeah, well, you wouldn't. We would not expect that you would simply allow it to expire without further announcements of what your plan is.
We would certainly announce if we intend to allow it to expire.
Or other options available.
Yes, of course.
Thank you. Madam Secretary, our debt as a share of GDP, most economically and meaningful a measure of debt, has climbed above 120%. In September and November, I asked you when we should say enough is enough when it comes to our debt and deficit. You felt that since the cost of servicing our debt had been negative due to a long stretch of low rates, our debt has been less burdensome. However, due to skyrocketing inflation, the Fed just raised rates by 50 basis points for the first time since 2000, and we could see 5 more hikes before the end of the year. Do you think it's finally time to start sounding the alarm bells? And if not now, what level of interest rates would alarm you?
Well, I do feel we have to make sure that the United States is on a sound fiscal path, and that's an important priority, obviously, for Treasury and for the administration. The projections that were made in the budget assume that interest rates will rise over time, that they were abnormally low. And so my statement that real interest costs were quite low, of course they would rise over time, but still remain at quite low levels, even if interest rates increase. But certainly longer term, we've known for a long time that as we have an aging population, that a larger share of U.S. GDP will go to Social Security, Medicare, Medicaid, and that we need to address issues in connection with financing those programs if we fail to attend to them, that most very long-run analyses show debt growing in a manner that could be worrisome. At the moment, the debt-to-GDP ratio is not increasing. Revenues are coming in very strong. This year, the deficit will decline by, we expect, by over $1.5 trillion. And my guess is that CBO and others will be revising down somewhat their likely path for the debt to GDP ratio.
Thank you. Mr. Chairman, my time has expired.
Senator Reid from Rhode Island is recognized.
Thank you very much, Mr. Chairman, and thank you, Madam Secretary, for your service. Last year, our economy grew